Imagine waking up, right, bracing for World War III, and by lunch, the war is canceled by a social media post.
Right.
Global oil completely plummets, and Elon Musk is officially crowned the first trillionaire in human history.
It's wild.
And that's not a hypothetical scenario we are workshopping today. I mean,
Yeah.
that is literally today, Friday, June 12th, 2026.
Yeah, it is the absolute definition of a historic inflection point. We're
Yeah.
looking at this massive collision of, macroeconomic forces, geopolitical brinkmanship, and frontier technology.
Right.
And you just rarely see all of that intersect on a single calendar day, let alone within, like, a single trading session.
Which is exactly why we are here.
Yeah.
So welcome to the deep dive. You are joining us on a day where the global map is essentially being redrawn in real time.
Completely redrawn.
Yeah. And our mission today is to take this massive stack of real-time market analyses, central bank monetary policy reports, software sector earnings calls, and all these breaking geopolitical dispatches, and we're going to weave them together for you.
Because we're looking at how a canceled military strike, shifting central bank mandates, and a totally record-shattering tech IPO are just fundamentally reshaping the global economy as we speak.
Yeah, because, I mean, if you view these events in isolation, they're just noisy headlines.
Right, exactly. But taken together, they reveal this profound narrative about where global capital is flowing and, more importantly, what global capital is genuinely terrified of.
Right. Okay, let's unpack this. So just to give you a sense of our analytical bedrock today, we are pulling from a really diverse array of sources.
Very diverse.
We have financial dispatches and market notes from Saxo Bank, Charles Schwab, and XTB. We also have the official monetary policy decisions straight from the European Central Bank over in Frankfurt.
And we're also integrating some really good deep dive earnings analysis from Futurum Research,
Oh, yeah.
specifically targeting the enterprise software sector.
Good.
And of course, we're pulling from detailed, real-time institutional reports on the day's staggering stock market movements and that highly anticipated SpaceX IPO.
It's a massive stack. It's designed specifically to bridge that gap between macroeconomic theory and the brutal reality of actual market mechanics.
Yeah, exactly.
Now, a quick but really crucial note before we jump into the geopolitical epicenter. The materials we're reviewing today contain real-time updates on highly sensitive, ongoing geopolitical conflicts in the Middle East,
Right.
specifically regarding the standoff between the United States and Iran. Now, our goal here is to impartially report the facts, the data, and the resulting market reactions exactly as they are presented in the source material.
Because we are analyzing the financial and economic impact here. We're not taking any political sides or endorsing any political viewpoint.
Right, our mandate is strictly analytical. We are looking at how these kinetic events alter risk models, influence central bank governors, and reallocate capital.
So let's start right there with the catalyst for this entire market surge. Because for weeks, institutional desks have been pricing in what looked like an inevitable direct military conflict.
Yeah, the pressure was building, the hedges were in place, and then the valve just suddenly released.
The primary driver of today's just violent upward trajectory in equities was a sudden and dramatic de-escalation between Washington and Tehran.
And the specifics from the sources paint this really fascinating picture of modern diplomacy. I mean, this all kicked off with a Truth Social post from President Donald Trump announcing the sudden cancellation of scheduled strikes and bombings against Iran.
Right, and the wording in the geopolitical source is incredibly specific here. It's legally loaded.
Yeah, he noted that the naval blockade will remain in full force and effect until a transaction is finalized.
Right, that specific word, transaction.
Mhm.
It's doing a lot of heavy lifting in a diplomatic context.
How so?
Well, it completely reframes the standoff. It implies a negotiated, reciprocal exchange, like a structural deal,
Oh, I see.
rather than a unilateral surrender or some protracted, grinding stalemate. And the timeline the market is now reacting to moved incredibly fast.
Yeah, the sources note he spoke from the Oval Office shortly after, stating the documents are in pretty final shape,
Yeah.
and the whisper numbers suggest this signing could happen as soon as this weekend in the French Alps at the G7 summit in Évian.
Which is just crazy fast.
Right. So we go from the absolute brink of a kinetic regional war to a potential signing ceremony in a matter of hours. How does the institutional market actually absorb that kind of whiplash?
Well, the reaction was immediate. The XTB report described it accurately as a violent risk-on reversal. We saw the VIX, the fear gauge or volatility index, plummet 12.5% down to 19.44.
Wow.
And, a drop below 20 on the VIX fundamentally changes how algorithmic trading models behave.
Right, because when the VIX drops, these massive systematic funds that target specific volatility levels, they're mechanically forced to buy equities. But beyond the algos, what is happening on the human trading desks? I mean, when the Dow jumps almost 2%, the S&P 500 rises 1.8%, and the Nasdaq surges 2.5% in a single session. That's not just retail enthusiasm.
No, no. It is the synchronized unwinding of institutional tail risk hedges.
Break that down a bit.
Sure. Think about how a portfolio manager operates when a war in the Middle East is looming, one that could totally choke off global energy supplies. They are forced to buy downside protection.
Right, they have to armor their portfolios.
Exactly. They buy out-of-the-money put options to protect against a crash, but that protection acts as a massive drag on their performance.
Because it's expensive insurance.
Very expensive.
Yeah.
So when the president posts that the strikes are canceled and a transaction is imminent, that tail risk is suddenly removed from the probability matrix.
So those expensive put options are immediately liquidated.
You got it. The managers sell their downside protection and ruthlessly reallocate that capital back into equities so they don't severely underperform their benchmarks during the resulting relief rally.
Wow.
Yeah, they abandon the geopolitical worst-case scenario models and rush back into fundamental corporate valuations.
Which brings us to what the Schwab report calls the oil puzzle. And looking at the raw data, it really does shatter a lot of historical assumptions about how energy markets are supposed to behave during a Middle East crisis.
It really does. It completely defies the traditional playbook from the 1970s or even like the early 2000s.
Yeah, so the sources note that oil is up roughly 30% since this current conflict started. But West Texas Intermediate, the U.S. benchmark, topped out at $112 a barrel back in April.
Right.
And I mean, $112 elevated, obviously. But let's look at the historical context here. In 2008, oil peaked at $145 a barrel. And the Schwab report helpfully points out that, adjusted for inflation, that 2008 peak would be $227 in today's money.
That delta is staggering.
Right. We were looking at arguably the biggest potential supply disruption in modern history. A naval blockade, the active threat of strikes, an entire region on edge, and WTI peaks at $112.
Yeah.
Why didn't we see a $200 barrel of oil? The math on the surface doesn't seem to add up. Why didn't the biggest supply shock in history trigger a proportionately massive price spike?
What's fascinating here is that the global energy infrastructure of 2026 is far more decentralized and brutally adaptable than the market of 2008.
Okay.
The sources break down the underlying mechanics of this puzzle into three very specific mitigating factors. The first is China's strategic maneuvering.
Right. China aggressively managing the demand side of the equation.
Precisely. The reports detail that China systematically cut its oil imports by millions of barrels a day beginning in May.
Wow.
Now, they didn't slow down their industrial base. They simply stopped buying on the open global market and tapped aggressively into their own strategic petroleum reserves.
Oh, that makes sense.
Yeah. By voluntarily stepping away from the international bidding war, China removed a massive chunk of global demand, which acted as a powerful immediate counterweight to the supply fears driving up the spot price.
Okay, so China stepping back absorbs some of that panic demand, but that alone doesn't explain the missing crude at the processing level. I mean, refineries must be hitting the brakes too, right? Because if the crude isn't moving, someone isn't refining it.
That is the second major factor. Global refineries are currently processing roughly 5 million fewer barrels a day than they were prior to the conflict.
5 million fewer.
Yeah. And this is where we have to look at crack spreads.
Right. The margin refiners make between the cost of crude oil and the price of the refined products like gasoline or diesel.
Exactly. If global macroeconomic growth is sluggish, the demand for refined petrochemicals drops. If refiners can't sell the end product at a high enough margin, they simply refuse to buy the underlying crude oil at elevated wartime prices. So they throttle back their processing, which essentially destroys crude demand further down the supply chain, naturally capping the price of a barrel.
Okay, and the third factor deals with the actual physical choke point itself.
Yeah.
The Strait of Hormuz.
Yes. Despite the overarching media narrative of a total hermetic closure due to the naval blockade, the maritime logistics reality is much more nuanced.
Right.
The sources estimate that roughly 2 million barrels of oil are still physically navigating through the strait every single day.
Even though the sources note that 2 million barrels is only about 10% of the pre-war flow?
Right. It is a severe restriction, absolutely. But in a tightly constrained global market that trades on marginal barrels, the difference between zero flow and 2 million barrels is the difference between a severe headache and a total systemic heart attack.
It's like bracing for a catastrophic highway bottleneck.
Yeah,
You hear the main interstate is completely shut down due to an accident. You panic and you assume the regional supply chain is going to freeze for days.
right.
But then you find out one lane is actually still inching along.
Yeah.
And a massive fleet of delivery trucks, in this case China and the global refineries, just decided to pull off at the rest stop and wait it out anyway.
That's a great way to look at it.
The catastrophe is averted, even if the road is still a mess. So, if the worst-case scenario is off the table, what does this drop in oil prices actually mean for the average person?
But that highway analogy maps perfectly onto the maritime logistics here. The options market had aggressively priced in a total zero-flow closure. The reality was a severely restricted but stubbornly functional trickle.
Yeah.
And when the de-escalation was announced today, crude oil spot prices immediately cratered. They dropped about 4% in just 15 minutes, pushing WTI down near $85 a barrel.
Which is huge. So how is this actually trickling down to the real economy? What does this mean for consumer psychology?
We can see the immediate transmission of that relief in today's University of Michigan Consumer Sentiment Index. It's surprised heavily to the upside, hitting 48.9.
Which, according to the sources, is a 9% sequential increase from May.
Yes. And the data internals show the primary driver of that bump was direct relief at the gas pump. Gasoline prices dropped from an average of $4.50 to $4.10 early in the month.
40 cents a gallon is a very tangible, immediate increase in discretionary income.
Especially for lower-income demographics. The distribution of the sentiment gains shows that lower-income households recorded the sharpest improvement.
Because fuel is such a bigger part of their budget.
Right. Fuel costs represent a highly inelastic portion of their household budgets. I mean, they have to drive to work regardless of the price.
Exactly.
So when gas drops 40 cents, that is immediate unencumbered cash flowing straight back into their wallets, and it instantly boosts their forward-looking economic outlook.
But, looking at the broader historical context in these sources, it paints a pretty sobering picture. Even with a 9% month-over-month bump, a consumer sentiment score of 48.9 is historically abysmal.
Oh, it is deeply entrenched pessimism. The report explicitly notes that despite this energy-driven rebound, overall sentiment remains 19% lower than it was a year ago.
Wow.
And a staggering 41.6% below the long-term historical average.
Why is the American consumer still so profoundly depressed if the geopolitical risk premium is collapsing and the pumps are getting cheaper?
Because the structural inflation in non-discretionary categories hasn't evaporated. The reports point out that consumers remain heavily anchored to everyday living costs.
Like housing.
Exactly. Specifically, the lingering, stubborn inflation in housing and food. You might save $20 filling up your sedan, but if your rent is up 15% and your grocery bill hasn't retraced a single cent from its peak, your overall perception of the economy remains aggressively negative.
Right. So gas prices are giving consumers a breather. You'd think the inflation fight is winding down, but if we look upstream, things are still running incredibly hot.
This is the critical pivot. The consumer is experiencing localized relief, but the industrial base is still radiating heat.
Let's talk about the May Producer Price Index, the PPI. This is the inflation businesses are facing on the manufacturing and wholesale side before they attempt to pass those costs on to the consumer. And the May data was a brutal reality check for anyone hoping the inflation narrative was behind us.
The headline numbers were stark. The PPI rose 1.1% month over month, which is the highest monthly acceleration since November 2022.
Wow.
And on an annualized basis, year over year, it increased by 6.5%.
But couldn't you argue that 6.5% is just a lagging indicator from the oil spike we just talked about?
You could try, but the core PPI data totally destroys that argument. Core PPI strips out the volatile food and energy sectors entirely.
Okay.
And that metric rose 0.8% for the month and 5.1% year over year. So this is not just an energy distortion skewing the wholesale data.
What's fascinating here is the sheer mechanics of how inflation embeds itself. I mean, the initial energy shock from the Middle East standoff didn't just stay isolated in the transportation sector.
No, it didn't.
It successfully transmitted into the broader production of hard goods and services. Like when diesel costs more for 6 months, shipping contracts get renegotiated higher. When raw petrochemicals spike, plastics manufacturing costs rise. Those elevated costs become permanently embedded into the supply chain contracts. We're no longer dealing with a transient spike. We are looking at a very sticky inflationary floor.
And this sticky floor is creating an absolute nightmare for central bank governors globally. I mean, they're all staring at the same sticky inflation data, but they are constrained by wildly divergent regional economic realities.
Let's start with Europe, because this exact dynamic forced the European Central Bank's hand yesterday. What was the ECB's maneuver?
Well, the ECB officially hiked its three key interest rates by 25 basis points.
Okay.
This pushes the rate on their primary deposit facility up to 2.25%. And the accompanying press conference from ECB President Christine Lagarde was deeply analytical and, as the sources characterize it, moderately hawkish.
So they are actively tightening financial conditions.
Right.
And the ECB's internal staff projections highlight exactly how precarious their situation is.
Right.
They revised their 2026 inflation projection upward to 3.0%.
While simultaneously downgrading their 2026 economic growth projection to a meager 0.8%.
Wait. Let's play devil's advocate here. They are officially projecting less than 1% economic growth for the entire Eurozone this year.
Yeah.
Their industrial base, particularly in Germany, is already struggling. And their response is to raise interest rates.
Right.
By deliberately making capital more expensive, aren't they actively risking pushing a stagnant European economy into a deep structural recession?
It is a massive calculated risk and one they are acutely aware of. But this highlights the fundamental divergence in global policy.
How so?
The ECB is essentially backed into a corner by geography. European policymakers are prioritizing price stability over economic growth because Europe is uniquely structurally vulnerable to the exact type of energy price fluctuations caused by the Middle East conflict.
Because they lack the domestic energy production of the U.S. and rely heavily on imported LNG and crude.
Exactly.
Yeah.
The ECB explicitly cited the inflation pressures emanating from the Iran conflict and the prolonged Strait of Hormuz maritime disruptions as the primary drivers forcing this hike.
Wow.
For the ECB Governing Council, a prolonged multi-year period of 3% inflation driven by external energy shocks that devalue the euro's purchasing power is considered vastly more dangerous to their long-term sovereign stability than triggering a near-term manufacturing recession.
So they are rigidly drawing a line in the sand on inflation expectations, even if it requires suppressing domestic growth to achieve it.
Exactly.
So while Europe is weaponizing interest rates to punish their economy into cooling down, let's look across the Atlantic at the U.S. Federal Reserve, because the posture in Washington is completely different.
It is a striking divergence in monetary philosophy. The Federal Reserve meets next week, marking the first FOMC meeting under the newly appointed Fed chair, Kevin Warsh. And the overwhelming market consensus, heavily detailed in the FHLBNY and Saxa reports, is that the Fed will remain firmly on hold. They are expected to keep their target federal funds rate steady at 3.50 to 3.75%.
But why does the U.S. Fed have the political and economic luxury of waiting while the ECB feels compelled to aggressively hike? The U.S. is facing that same sticky 6.5% headline PPI we just broke down.
The divergence is rooted entirely in the underlying resilience of the domestic labor market. The U.S. economy can currently absorb these higher 3.5% interest rates without immediately buckling into a recession.
Right.
And the sources point to the SAM rule to quantify this resilience.
But let's look at how the SAM rule is actually behaving right now, because a lot of analysts argue that post-pandemic labor hoarding has broken traditional employment indicators.
It's a valid debate, but the raw data is compelling. The SAM rule triggers a recession warning when the 3-month moving average of the national unemployment rate jumps 0.5% above its 12-month low.
Okay.
Currently, that indicator is sitting at just 0.1 in the U.S.
So it is absolutely nowhere near the warning threshold.
Correct. The report explicitly categorizes the U.S. as being far from a warning zone. Furthermore, high-frequency data like initial jobless claims came in this week at just 229,000.
Which indicates that despite the high cost of capital, U.S. corporations are not executing massive structural layoffs.
Precisely. The U.S. labor market is exhibiting remarkable structural strength. And because employment isn't collapsing, the Fed has the luxury of time.
They don't have to panic.
Right. They don't have to panic hike rates to aggressively crush the 6.5% PPI, nor are they forced to rapidly cut rates to stimulate a failing job market.
They can just maintain an on-hold posture.
Exactly. Letting the current 3.5% raise slowly restrict demand while waiting to see if the recent easing of geopolitical tensions naturally deflates that sticky inflation floor over the next few quarters.
Okay, so we have the ECB hiking to defend the euro against energy inflation, and the Fed holding steady at at elevated rates backed by a strong labor market. But what happens to the rest of the world when the two largest central banks diverge so sharply from the others?
Well, when global central banks operate on divergent monetary tracks, the resulting systemic pressure immediately seeks a release valve in the foreign exchange markets.
Okay.
Global capital flows continuously seek the highest risk-adjusted yield. And right now, this divergence is absolutely devastating the Japanese yen.
Yeah. The sources touch on the Bank of Japan's incredibly difficult position here. I mean, they are expected to hike, but they are operating in a completely different stratosphere than the Fed or the ECB.
Totally different. The Bank of Japan's policy rates are currently sitting at an anemic 0.30 to 0.75%.
Wow.
Contrast that with the Fed at 3.50% or the ECB at 2.25%. From the perspective of a global institutional allocator, the math is brutally simple.
Why keep your money there?
Exactly. Why would you keep your sovereign wealth or pension capital parked in Japanese government bonds, earning a fraction of percent, when you can execute a carry trade, moving it to the UF to earn over 3.5% in highly liquid treasuries?
You simply wouldn't. The fiduciary duty practically forces you to sell the yen, buy dollars, and capture that massive yield differential.
And that relentless synchronized outflow of institutional capital from Tokyo is aggressively driving down the value of the yen.
Right.
The sources note that this specific macro dynamic has punished the USD-JPY exchange rate, pushing it up to the 160.30 area.
Which is huge.
It creates a devastating feedback loop for Japan. A weaker yen makes importing raw materials and energy vastly more expensive.
Which imports inflation.
Yes, which forcibly imports inflation into their domestic economy, creating a nightmare scenario for a central bank that is already trapped by a massive sovereign debt load.
It is a brilliantly complex, interconnected global web. I mean, the ECB is forced to hike because of Middle East maritime disruptions, the Fed holds because of domestic U.S. labor strength, and the Japanese yen takes the resulting collateral damage of global capital flight.
Yeah, and if we connect this to the bigger picture, it highlights exactly how impossible it is to engineer a synchronized global economic policy when the underlying regional vulnerabilities are so radically different.
Okay, so central bankers are agonizing over basis points, right? Struggling to micromanage this sticky inflation and defend their currencies.
Right.
But while the public sector is preaching caution and restriction, the private market completely ignored them today. They stood up and poured an absolutely unprecedented, historic amount of liquidity into what might be the ultimate growth narrative of the 21st century.
The juxtaposition is almost jarring.
Right.
While policymakers are frantically trying to cool down the economy, institutional and retail investors just banded together to write a $75 billion blank check for the frontier of human technology.
So while central banks are tightening, the private market is throwing money at the stars. Let's transition to the event that completely consumed the financial news cycle today, the SpaceX IPO.
It is, without any hyperbole, a watershed moment for the history of global capital markets.
The raw numbers from the NASDAQ listing today are difficult to even comprehend. The IPO priced at $135 a share.
Yeah.
They unloaded 555.56 million shares onto the public market under the ticker symbol SPCX.
Right.
That offering alone raised roughly $75 billion in pure cash.
Making it the largest initial public offering in the history of finance, easily eclipsing the previous record holder.
Right. The state-owned Saudi Aramco listing back in 2019, and at that $135 offering price, SpaceX was instantly valued at $1.77 trillion.
And that $1.77 trillion valuation was merely the starting line.
It's crazy. The sources note that the opening auction on the NASDAQ was extended all morning just to process the unprecedented backlog of order flow.
Right.
When the stock finally opened for secondary trading, the very first trade printed at $150. That is an immediate 11% premium over the offering price.
Yeah.
And the momentum didn't stop. It ripped to an intraday high of $176.52.
Which briefly pushed the company's market capitalization well past the $2 trillion mark during the afternoon session.
And this liquidity event also shattered a massive personal wealth threshold. The IPO has officially crowned SpaceX CEO Elon Musk as the world's first trillionaire.
Unbelievable.
The reports estimate his personal net worth at an astonishing $1.1 trillion.
And the most critical aspect of that wealth metric, as the sources explicitly note, is that he didn't sell a single share of his personal holdings into this massive public offering.
Which brings us to the actual governance structure of the newly public entity. The SEC registration filings detail a very specific dual-class share structure.
Right.
The public bought Class A shares today, but the Class B shares carry 10 votes per share.
This is a vital mechanism that institutional investors had to accept. In a traditional corporate structure, one share equals one vote.
Right.
The collective shareholder base elects the board of directors, and the board has the fiduciary power to oversee or potentially fire the CEO. But in a dual-class structure, heavily weighted toward the
The
founder.
Class B shares.
Right. The Class B shares, which are tightly held by Musk and early insiders, possess super voting power.
10 times the voting power of the retail or institutional investor who bought in at $150 today.
Exactly. This means that even though SpaceX is now a publicly traded entity worth over $2 trillion, Elon Musk retains absolute, unbreakable control over the voting power and the strategic direction of the enterprise.
Wow.
The public investors are providing $75 billion in expansion capital, but they are legally barred from exercising any meaningful control over how that capital is deployed.
They're entirely along for the ride, but looking at the allocation data, the public desperately demanded a seat on this specific ride.
Oh, yeah?
One of the most fascinating details from the syndicate reporting is the sheer volume of retail investor participation. The sources note that everyday retail investors received roughly 30% of the entire offering allocation.
That is highly anomalous for an offering of this magnitude.
Right.
In a typical mega-cap U.S. listing, retail brokers might fight for 5 to 10% of the shares, with the vast majority being meticulously allocated to institutional mutual funds, sovereign wealth funds, and massive hedge funds.
But the retail demand was so ferocious that firms like Fidelity actually restructured their internal rules. They aggressively lowered their account minimums, specifically so every day lower-tier investors could participate in the IPO allocation.
It's incredible.
It's almost as if they aren't selling traditional equity. They are selling early citizenship to a future Mars colony. People aren't running discounted cash flow models. They are buying a philosophical stake in human expansion.
The psychological phenomenon surrounding this listing cannot be overstated. It transcended traditional financial metrics and captured the global public imagination in a way that perhaps no financial event ever has.
But let's bring the narrative back down to earth for a minute and look at the actual balance sheet. What exactly is a private corporation doing with a sudden influx of $75 billion in cash?
Right.
That is a literal nation-state level of capital. You don't just park $75 billion in a corporate money market fund.
The natural assumption for a company named Space Exploration Technologies is that next-generation rockets or lunar landers would be the undisputed priority for that capital. But the S-1 registration statement reveals a very different strategic roadmap.
Here's where it gets really interesting.
The top stated use of the $75 billion in proceeds isn't the Starship launch vehicle. It is the massive expansion of their AI compute infrastructure.
Artificial intelligence.
Yes. Remember, earlier this year, SpaceX executed a highly strategic all-stock merger with xAI, the artificial intelligence firm responsible for the Grok language models.
Oh, right.
SpaceX is fundamentally repositioning its core identity. The IPO proceeds are earmarked first and foremost for building out unprecedented AI data centers and compute clusters.
Wow.
That is followed secondarily by the continued development of the Starship architecture and finally the expansion of the Starlink global satellite constellation.
So they are viewing their orbital infrastructure not just as a telecom play, but as the ultimate decentralized global data platform for artificial intelligence.
Exactly. They aren't just launching physical hardware into orbit anymore. They're attempting to build an omnipresent, space-based, AI-driven connectivity layer for the entire planet.
That's a massive ambition.
And the sheer scale of this ambition has completely fractured the financial analyst community, sparking an incredibly intense valuation debate.
Because how do you accurately value a company that is simultaneously attempting to colonize a neighboring planet while building a monopolistic global AI network? Standard GAAP accounting metrics completely break down.
They absolutely do. And the contrast in the analyst notes highlighted in the sources perfectly illustrates this divide.
Let's hear it.
On one side of the spectrum, you have Morningstar. They are a historically conservative, fundamentally driven research firm. They evaluated SpaceX using a traditional discounted cash flow model.
But applying a standard DCF to a space AI hybrid seems almost intentionally blind to the upside. I mean, a DCF relies on projecting predictable near-term cash flows.
Right.
How can you project the 10-year cash flow of a Mars logistics contract or a proprietary AI network that doesn't fully exist yet?
Morningstar would argue that a fundamental valuation must be rooted in current financial reality,
Right.
not speculative science fiction.
Fair enough.
And the financial reality they focused on is that SpaceX reported a net loss of $4.3 billion in the first quarter of 2026 alone.
Ouch.
Applying their rigorous cash flow-focused model to that massive burn rate, Morningstar values the entire enterprise at $780 billion.
Which is still an objectively massive number, but it is less than half of what the open market decided the company was worth today.
Because the market completely ignored Morningstar and embraced the opposing side of the debate. Analysts at Oppenheimer, for instance, issued an aggressive outperform rating and slapped a $2.5 trillion valuation target on the stock.
How does an analyst mathematically justify a $2.5 trillion valuation for a company that just incinerated $4 billion in a single quarter?
By entirely abandoning near-term cash flow metrics and focusing exclusively on the total addressable market, or TAM.
Ah, the TAM.
Yeah. Oppenheimer's thesis argues that SpaceX is no longer competing in the launch provider market. They are competing for the future of global digital infrastructure.
Right.
SpaceX's own internal projections state they are targeting a market opportunity of over $28 trillion across all their integrated verticals.
Unbelievable.
And a staggering 90% of that massive TAM is attributed specifically to the newly acquired XAI division. If an analyst believes SpaceX will capture even a modest fraction of a $28 trillion total addressable market, a $2.5 trillion current valuation suddenly seems like a bargain.
It is the ultimate philosophical debate between what a company is tangibly earning today versus the sheer scale of the global economy it could theoretically dominate tomorrow.
And today, looking at the tape, the market overwhelmingly voted for tomorrow.
But this massive $75 billion blank check for SpaceX's AI ambitions stands in brutal, stark contrast to what happened in the rest of the tech sector today.
It really does.
Because while investors were indiscriminately throwing capital at SpaceX's vision of the AI future, they were simultaneously heavily punishing legacy software giants who are actually trying to implement and monetize AI in the present.
This is the AI reality check the market has been waiting for. Institutional investors are suddenly getting ruthlessly analytical about how artificial intelligence is funded,
Yeah.
how the infrastructure is built, and exactly when it will become profitable.
Let's examine Adobe's Q2 earnings report. On paper, if you just read the headline numbers, it looks like an absolute blowout.
Right.
They reported record revenue of $6.62 billion, which is up 13% year over year. They comfortably beat consensus earnings estimates. And critically, their specific AI-first annualized recurring revenue, their ARR more than tripled year over year, eclipsing $500 million.
Those are undeniably robust top-line performance metrics.
So if they are hitting record enterprise revenues and successfully tripling their AI-specific ARR, why did the market punish them so severely? I mean, the stock dropped over 6% in regular trading and continued to bleed out in the after-hours session.
The deep dive analysis provided by Futurum Research unpacks the mechanics of this sell-off brilliantly. The market didn't punish Adobe for the historical data of Q2. The market punished them for the strategic operational choices they are communicating for the second half of the year.
Okay, what choices?
Adobe is executing a massive, high-risk, freemium pivot.
But isn't that just a convenient excuse for missing forward-looking ARR targets? Silicon Valley has been using the user growth excuse to hide deteriorating unit economics for over a decade. Whenever revenue growth slows, tech CEOs suddenly claim they are prioritizing community acquisition.
That is exactly the skepticism Wall Street is pricing in. Adobe's strategy is designed to maximize top-of-funnel user acquisition by offering massive AI capabilities for free.
Right.
And the raw user metrics are staggering. Adobe reported that their freemium monthly active users hit 90 million, while their broader Acrobat and Express platforms reached 850 million active users globally.
850 million users is an incredible distribution network.
It is. But here is the critical friction point. To drive that massive scale, Adobe is intentionally deferring near-term revenue capture.
Deferring it.
Yeah. They explicitly stated they are delaying planned optimizations to their enterprise pricing tiers optimizations that analysts were counting on to boost annualized recurring revenue in the next 2 quarters.
Ah, I see.
They are deliberately sacrificing immediate predictable cash flow in a gamble to capture a dominant market share for the long term.
And in a macroeconomic environment where the Fed is holding rates at 3.5%, Wall Street has absolutely zero patience for companies sacrificing near-term cash flow.
Especially when that sacrifice is tied to a largely unproven AI monetization strategy. The Futurum analysis points out that Adobe is betting that this massive initial user acquisition, combined with a yet-to-be-defined usage-based AI monetization model later down the road, will ultimately yield higher lifetime value per customer. But the market looked at that strategy and violently rejected it. Institutional investors are saying, we don't want speculative top-of-funnel promises. We demand locked-in, high-margin ARR today.
And to add a massive layer of uncertainty to an already risky strategic pivot, they announced their chief financial officer is departing. Right in the middle of a prolonged, ongoing search for a permanent CEO.
Executive leadership uncertainty combined with a strategic pivot that actively suppresses near-term revenue is a highly toxic combination for equity valuation, regardless of how strong the historical earnings were.
Okay, so Adobe got hammered for sacrificing immediate revenue to chase AI user growth. But then we have Oracle. Oracle also beat their consensus earnings estimates today, yet their stock dropped 8.5%. What was the catalyst for that sell-off?
Oracle's specific situation highlights the other, arguably more dangerous side of the AI reality check, the sheer staggering capital expenditure required to physically build the infrastructure that runs these foundational models.
Right, the actual hardware, the advanced cooling systems, the massive data centers, and the raw energy requirement.
Precisely. Oracle is aggressively building out next-generation AI cloud infrastructure to compete with AWS and Azure.
Which isn't cheap.
Not at all.
Well,
And when investors dissected the earnings report, they started deeply questioning the sustainability of the massive cash burn, the billions in capital expenditures required just to maintain parity in the AI arms race.
so what does this all mean if we step back and look at the whole board today? We just saw the market hand SpaceX $75 billion based on the mere promise of building the ultimate AI compute network,
Yeah.
while simultaneously wiping billions off the market cap of Adobe and Oracle, despite them posting strong actual revenues.
It's a stark contrast.
Are we hitting a structural wall where investors love the theoretical idea of an AI revolution, but they absolutely refuse to pay the brutal capital expenditure bills required to build it in the present?
You have correctly identified the core dichotomy of the current market cycle. Institutional capital is becoming highly sophisticated and ruthlessly selective in how it values AI narratives.
Okay.
They are more than willing to grant infinite valuation multiples to a frontier entity like SpaceX, which is viewed as a monopolistic foundational builder of the future architecture.
But for the older company.
For legacy enterprise companies like Oracle or Adobe, the market is entirely unforgiving. They are drawing a hard line between companies they believe will extract pure profit from the AI transition and companies that are currently bleeding billions in cash just to survive the transition.
If your balance sheet is bleeding cash to build the data centers, or you are artificially suppressing your revenue to acquire AI users, the market will aggressively re-rate your stock downward.
And this ruthless bifurcated differentiation poses a severe systemic risk to the broader financial system, which brings us to the final, highly cautionary point detailed in the Schwab report.
The concentration risk in the broader indices?
Yes. The Schwab macro report highlights a stunning and frankly terrifying statistic about market breadth. Just 10 individual stocks now represent a massive 40% of the entire market capitalization of the S&P 500 index.
10 companies. That means 10 companies dictate nearly half the value of the 500 most important corporations in the American economy.
Exactly.
And I am guessing all 10 of those mega caps are deeply tethered to this specific AI growth narrative.
They are entirely reliant on it. Now, as we noted at the top of the hour, the relief rally today did temporarily broaden out into cyclical sectors like materials and financials due to the sudden removal of the Middle East geopolitical risk.
Right.
But structurally, this massive historic concentration in a handful of mega-cap tech stocks poses a profound systemic fragility.
Because if the AI thesis falters, the entire index collapses under its own weight.
Exactly.
Yeah.
The report details that the vast majority of the projected earnings growth for the entire S&P 500 in 2026 is narrowly isolated within this specific tech cohort.
So it's heavily localized.
Extremely localized. If the institutional AI growth narrative cracks, if enterprise customers push back on pricing, if the infrastructure CapEx becomes too burdensome, or if the actual return on investment for these AI tools fails to materialize,
So it's going to be bad.
The resulting valuation correction won't be confined to the Nasdaq. It will violently drag down the entire S&P 500.
It's like engineering a massive skyscraper where 40% of the structural load is resting on a single, highly experimental pillar.
That's a perfect way to put it.
I mean, it might be a spectacularly strong pillar today, but if it develops even a microscopic fracture, the entire building comes down.
Which is precisely why institutional analysts are aggressively advising their clients to diversify away from this concentration, seeking refuge in international equities or boring cyclical sectors as a necessary buffer against this massive AI risk premium.
Wow, what an incredibly dense, overwhelming day of economic data and market mechanics. Let's try and synthesize the sheer scope of what we just analyzed for Friday, June 12, 2026.
Yeah, it is a specific trading session that will undoubtedly be dissected in macroeconomics courses for the next decade.
So we started the morning staring down the barrel of a major geopolitical disaster, with markets bracing for an open, kinetic conflict between the U.S. and Iran.
Right.
That tail risk was suddenly removed by a rapid diplomatic pivot, releasing a massive pressure valve on global markets, forcing a violent unwinding of institutional hedges, sending equities soaring, and crushing spot oil prices back down to reality.
Right. A sequence of events that provided the global consumer, who has been battered by structural inflation, a desperately needed psychological and financial reprieve at the gas pump.
Yet, underneath that localized relief, we saw the European Central Bank draw a hard, hawkish line in the sand, aggressively hiking interest rates into an actively slowing economy.
Because they simply cannot tolerate the sticky inflationary floor embedded by regional energy shocks.
Right. Meanwhile, the U.S. Federal Reserve sits comfortably on hold, anchored by a remarkably resilient labor market, leaving the Bank of Japan and the Japanese yen to absorb the devastating collateral damage of global capital flight and yield differentials.
And amidst all this macroeconomic anxiety and central bank maneuvering, the private equity market orchestrated the largest transfer of capital in the history of public listings.
Right, handing SpaceX and Elon Musk a historic $75 billion mandate to build an AI-driven, space-based digital infrastructure, crowning Musk the first trillionaire.
All while the very same public market violently punished legacy enterprise tech giants like Adobe and Oracle.
Proving that while investors are intoxicated by the dream of an AI future, they are increasingly hostile toward the exorbitant capital expenditures required to actually build it in the present.
It is a remarkable, deeply complex dichotomy of capital allocation.
Before we wrap up, I want to leave you with one final, broader thought. The expert and I were reviewing the upcoming diplomatic agenda for the G7 summit in Évian, France, where global finance ministers and central bankers are gathering this weekend to discuss the fallout of everything we just covered.
And we connect this to the bigger picture. There is a very specific, deeply thought-provoking detail buried in the G7 preparatory materials.
What's that?
The G7 finance ministers are formally warning of dangerous systemic global trade mismatches. They are explicitly describing the current architecture of the global economy as a highly precarious world of savers and spenders.
They are worried about the fundamental fragility and the shifting balance of power within the traditional nation-state economic system.
Yes, it is.
And I want you to mull this over as you watch the markets open next week. At the exact same moment that traditional sovereign nations are issuing dire warnings about systemic financial fragility and struggling to defend their domestic currencies and manage embedded inflation, a single private corporation, controlled absolutely by a single individual utilizing a super voting share structure, can effortlessly absorb $75 billion in liquid cash from the public markets in a single morning.
This juxtaposition raises a critical, defining question about the fundamental balance of power in the 21st century.
Are we entering an era where decentralized corporate technology entities, companies that monopolize global satellite communications and command foundational AI infrastructure, possess the exact same economic gravity and perhaps the exact same geopolitical leverage as the traditional sovereign nation states themselves?
It's fascinating.
I mean, when a tectonic shift happens in the global economy now, who is actually moving the plates?
It is a question that will undoubtedly dictate the trajectory of global economics for the remainder of the decade.
Something to think about as you watch the headlines this weekend. Thank you for joining us for this deep dive. Keep questioning the consensus narrative, keep looking for the mechanics beneath the surface, and we will see you next time.